Hello, welcome back. Today I'm going to model the risk and return of a simple two assets portfolio. I'm going to use two sample common stocks from Malaysia, which are Top Glove and Bursa Malaysia. The sample data is from beginning of this year, 2nd January 2020, up to the last trading day before I produce this video, which is 19 August 2020. I'm going to answer a research question. What is the impact of combining two stocks on the return and risk of a portfolio? I'm going to show you how modeling can be done via Excel. Hopefully you will learn something out of this video. Let's start. Have you heard about the idiom, don't put all your eggs in one basket? This is a piece of advice, which means that one should not concentrate all efforts and resources in one area as one could lose everything. When it comes to investment, mathematics model prove that this advice is valuable as it can reduce risk. Our objective is to model the return and risk of a portfolio with two risky assets, Bursa Malaysia and Top Glove. For your convenience, I have listed down the formula here for you. I hope you are familiar with this formula on measuring expected return and standard deviation. W is the weight of investment, which means the proportion of wealth we invest in each asset. From the standard deviation formula, you can observe that covariance or correlation plays a role in influencing the level of risk. From the Excel spreadsheet, I have listed the daily arithmetic return of Bursa Malaysia, daily arithmetic return of Top Glove. I have also calculated the mean and standard deviation of return for Bursa Malaysia and Top Glove. I have also generated a variance covariance metric for Bursa Malaysia and Top Glove, as well as calculating the correlation. I will not show you the detailed calculation of all these variables since I have taught that in my earlier videos in YouTube. Please refer to my video on descriptive statistics if you need a revision. My objective is to measure the return and risk of a portfolio with two assets. Through experience, I have learned three different ways to do it. Method 1, Method 2, and Method 3. I'm going to show you one by one. Do you see that I have highlighted the weight in red? This is an important input as all the subsequent input is related to this variable. For method 1, I'm going to make use of the formula that I have shown you just now. Let's assume that I have 100,000 ringgit. I'm going to invest 50,000 to buy Bursa Malaysia stock and 50,000 to buy Top Glove. So my weight in Bursa Malaysia will be 50% and my weight in Top Glove will be equal 1 minus the weight of Bursa Malaysia. I actually point the cell to make reference to the input without typing in the figures. Press enter and I have 50%. Alright, for the sum of weight, it will be equal weight of Bursa Malaysia plus weight of Top Glove. Enter and it will be 100%. If I change the weight to 30%, the weight of Top Glove will adjust automatically. I can change back to 50%. Alright, the expected return of the portfolio is equal weight of Bursa Malaysia times mean return of Bursa Malaysia plus weight of Top Glove times mean return of Top Glove. Enter and I obtain the answer. For variance of portfolio, according to the formula, it will be equal weight of Bursa Malaysia power of 2 times variance of Bursa Malaysia plus again weight of Top Glove power of 2 times variance of Top Glove plus again 2 times weight of Bursa Malaysia times weight of Top Glove times covariance between Top Glove and Bursa Malaysia, which is here. Press enter and I obtain the result for variance of portfolio. Standard deviation of the portfolio is equal SQRT, which means square root of the variance. Close bracket, and I obtain the answer. For method 2, I'm going to use matrix for modeling. I have listed down the formula here for your convenience. Here is the formula to measure portfolio standard deviation using matrix. You have a weight in horizontal, the transpose of the weights, the variance covariance matrix, and at the end, the formula for standard deviation. Please study this formula and it will be very interesting to construct a portfolio with many assets. Let's use method 2. Before I start, I need to create a transpose of the weight. I'm going to type equal, point this cell, enter, and equal, point this cell, enter to make a reference. I have created a horizontal matrix, a 1 times 2 matrix. This is a vertical matrix, which is 2 times 1. For expected return, the formula is equal MMULT, open bracket. I'm going to highlight the mean return, which is a 1 times 2 matrix, comma, and highlight the weight, which is a 2 times 1 matrix. Close bracket, enter. The result is a 1 times 1 matrix, which is the same as method 1. Next, I'm going to do it for variance, equal MMULT, open bracket. I'm going to highlight the weights of the Bursa Malaysia and Top Glove, comma, I'm going to highlight the variance covariance matrix, close bracket. I'm going to have one more matrix, equal MMULT, open bracket. I put it in front, type a comma here, and I'm going to highlight the weight of Bursa Malaysia and weight of Top Glove, which is a 2 times 1 matrix, close bracket. You can refer to the color to see how the matrix works. This is the horizontal weight times the variance covariance matrix times the weight again. All right, enter and you obtain the result. As for standard deviation, the formula is very straightforward. This is equal SQRT, square root of variance, close bracket, and you should get the same result. Now I'm going to show you method 3. Method 3 basically is to construct the daily portfolio return. So I'm going to put my mouse here, equal the weight of investment in Bursa Malaysia times the daily return of Bursa Malaysia plus the weight of return in Top Glove times the daily return of Top Glove. All right, I'm going to fix the cell for the weights. I'm going to type F4. All right, string the row and string the column. I'm going to type F4 for the weights of Top Glove as well. Press enter, then I have the daily portfolio return. All right, double click, and I have all the results up to August 19. After that, I can make use of this data to compute the portfolio expected return, which is equal average. You can make use of Excel formula, equal average, and highlight the data here. Close bracket, enter. So you have the portfolio expected return. As for portfolio variance, the formula is equal VAR dot S, open bracket, and highlight your data. All right, I can press Ctrl Shift down, close bracket, and I can highlight all the data. As you can see, the results remains the same. All right, I'm going to drag this over as a convenient way to get my result for standard deviation. So we have 3 results here which are the same using 3 different methodology. One good point about programming is I can easily change the weights of Bursa Malaysia and get a new result for the portfolio. For example, I'm going to invest only 10% of my money in Bursa Malaysia. What happened? 90% of the fund will be invested in top glove and the standard deviation will change accordingly. I can also have 100% of my investment invested in Bursa Malaysia and none of the money is invested in top glove. It will come back to the standard deviation of Bursa Malaysia, as you can see here. All right. I can also have, let's say, 30% in Bursa Malaysia and 70% in top glove, and the result will change automatically. This is the beauty of modeling. In future, we are going to learn how to model a portfolio with the lowest standard deviation. Will it be interesting for you? Let's see. The major findings from this modeling is the portfolio standard deviation is lower than the summation of individual standard deviation of the two assets. So we can conclude that diversification benefit is achieved with the reduction in the overall portfolio risk.